Okay, so before we get into the fund focus, we received an email from Crispin Gwandure. He, of course, is a viewer and watches Wealth Quest. He's a great fan of Wealth Quest, he says. And here's a question for us, and just very quickly, basically summarizing what it says. The question is around whether the best option to put a monthly debit order into buying up unit trust of around 1,500 Rand or putting in a lump sum. And then the next question is, how do you choose which is the best unit trust to use out of the whole universe of unit trust? So Cobie, can you answer that question in a kind of 30 seconds for us at all?
Yeah, I mean, look, phasing in versus lump summing, that all depends again on lifestyle. It depends on what you're trying to achieve and how you're trying to achieve it. The choice of unit trust is directly linked to, again, what you're trying to achieve at your age and exactly what you're trying to save for long term. Now, you know, we're talking about somebody here that's younger in age, and we're talking about somebody that wants to kind of save long term. Equities will play a profound part in that, but to what degree, that only you'll be able to say once you've gone through a full lengthy kind of advisory process with an individual such as this.
What were the questions that you would ask him, Roland? He's in his 20s, and these are the, you know, he wants to basically start earning money and putting money away for a rainy day.
Well, as a young person in your mid-20s, you have some essential costs like buying a car or paying for education. So maybe those are actually important to get out the way so you don't get into debt very quickly. And maybe if he's got a lump sum, he should consider paying off those costs which are essential. If he doesn't have a problem with funding cars and education, he can probably get away with a monthly debit order and just keep doing it for as long as possible.
And in terms of the unit trust, I know you can't actually advise on one specific unit trust. So the key questions in terms of your considerations, we know we talk about this all the time across the shows, risk and reward, but run us through those again.
But more importantly, past performance is no indication of future performance.
Yeah.
You know, so if you're going to choose the best performing fund in the past, there's absolutely, and as a matter of fact, research actually shows the best performing fund last quarter or the best performing fund last year is not going to be the best performing, you know, fund going, you know, potentially in the next 12 months or next period. So he's got to align himself philosophically to what the manager is actually trying to achieve. And that's got to kind of speak to his heart. And then he's got to sit with those fundamentals, and he's got to sit down and he's got to say, well, does that help me achieve my objectives? And I mean, Roland spoke a little bit about those objectives. And then literally throwing his lot in with the manager and then allowing his money to compound out for him. Now, I mean,
we talk about this on Wealth Quest all the time. So what we're going to do is we're going to send Crispin rather an email and delve into that. And of course, keep watching Wealth Quest because we're always talking about the type of things that you need to consider when you're looking at funds. But let's move on and focus in on the fund that we're focusing on today. It's the 361 Flexible Opportunity Fund. It is, of course, managed by 361 Asset Management. It has been, it was formed in 2005. It has a size of, what, 700 million Rand. The objective is a repo rate plus 2% and a TER of 4.94%. Sure, expensive there. Cobie, your views on the fund?
Yeah, I mean, let's have a look at some of maybe some of the returns. I mean, that's as a broad intro. I mean, that's pretty good. Remember that you know, you're looking at a total expense ratio here that probably takes some performance-based fees into consideration here as well. You know, so those will potentially drop at some point as well. Let's look at some returns. If you have a look there at your screen now, you'll see the fund's returns relative to benchmark. Remember, benchmark that you're looking at over here is the repo rate plus 2%. You see the returns; they look fairly decent against that benchmark. Obviously not a huge benchmark to beat, you know, depending again on your asset allocation and so on, but not a massively tight benchmark to achieve. Let's look at returns. These are the returns, and the blue shaded area is the fund's relative return to that benchmark. And there you can see the rolling 12-month repo rate, and that's in the red line that you're seeing kind of filter through your screen over there. If you look during as the sovereign crisis and the subprime crisis was playing themselves out during 2008 and 2009, you see some underperformance relative to that benchmark. But overall, you know, fairly decent outperformance relative to that. It is probably fairly opportune to maybe understand and also look at this fund relative to the all-share index, because there is an equity component here. And there you can see, if you just look at your screen quickly, you'll quickly see those. There you can see the rolling 12-month returns relative to the all-Z. See the you see the drawdown, you see the negative real returns for the funds, or should I say relative to all-Z, the absolute returns. And then as the fund kind of comes back, you see again the positive
returns. It's bounced back nicely, Roland. It's very much a stock picking fund. It's got assets mainly in South Africa across a broad range of sectors. Naspers is a big holding. MTN is a big holding. British American Tobacco. Would you be buying into this fund at a level that is so expensive, though?
Well, the current asset allocation is positioned very defensively. They've got a big holding in consumer goods and consumer services, and BTI and Naspers are key examples of that. The current situation with this fund is that I did some analysis on it, and the best allocation that explains the returns of this fund is about a 65% weighting in the all-share index, and the rest 35% in cash. And Cobie put up the two graphs, which are the two extremes. In other words, the cash kind of returns and the market as a benchmark. And the fund tracks a 65-35 kind of split. So you'll probably find if the market does really well, the all-share index, this fund will underperform because it's got a 65% exposure to the market. But if the market continues to go south, then this fund will add value. So it is defensively positioned.